Friend Sir Paul Tucker was Deputy Governor of the Bank of England from 2009 to 2013. It was the culmination of a long career at the bank beginning in 1980. He is now a senior fellow at the Harvard Kennedy School and the Harvard Business School, and was there for the birth, gestation, and implementation of QE in all its forms. Sitting to his left is Natasha Valla. Forgive my pronunciation. She is Deputy Director of CEPI, the leading French think tank, runs the scientific program of International Economics and Finance. She is a member of various boards, including that of SWERF. Previously had been Executive Director of Goldman Sachs Economic Research in 2014, where of course she was monitoring and assessing the market impacts of quantitative easing in its various forms over time. She's also been a consultant for the IMF and the OECD, and taught at Paris, Dauphine, and Peck. And furthest to the left, only for geographic purposes, is my friend Lamka Olipide, who I'm proud to say is a senior fellow at the Peters Institute. He's also co-director of global economics at D.E. Shaw and Company. He's been an advisor to many central banks. He's a founding member of the European Central Bank's Shadow Governing Council. He's an economic columnist for El País, forgive the pronunciation, and is the co-editor with me of our set of proposals on how to fix the euro area, including his essay, which quite nicely foretold some of what the ECB actually ended up doing. Copies are available outside for free. Please take them and read them and give them a try. The topic of this session is just following along based on Peter Pratt's excellent remarks, which is when we're on to quantitative easing in the euro area, what are the operational issues? How should we think about this? Things that both Peter and Eric have raised about open-ended or closed-ended programs, issues of what you buy, how you implement it, the plumbing, and particularly the communications, which is, as everyone has indicated, is a very critical but difficult part of the process. So if I could, I'd like to ask Paul Tucker to start for 8 to 10 minutes. And Paul, take this microphone of honor with you.
Thanks, Adam. One of the great things about having a surname that begins with T is that you very rarely go first on a panel. This is the first time in public speaking, which goes back a quarter of a century or more for me, that I have had two speakers with surnames in the alphabet that begins after T. So thank you for that, Adam. Actually, I'm quite pleased because it's good to speak after my good friend Peter Pratt. I want to say something about quantitative easing, and when Adam asked me to be here, I leapt at the chance because there are some things I want to say about it. I'm going to touch briefly on do I think it was the right thing to do, and then secondly on how I think it will work, what the transmission mechanism is, in which I will draw on some of our experiences at the Bank of England. Then I'm going to say something about the political economy or politics of QE and the debate here in the euro area, where the implicit question amounts to, has QE been too delayed because of the protracted debate, or was the protracted debate a necessary condition of an independent central bank functioning in a democracy? So towards the end I'm going to raise some pretty elevated questions about the rule of law and incomplete contracts, and I'm going to raise them because this continent needs those questions to be aired openly and also to be closed down and go away, because I think it's been impeding the operation of policy. So was it the right thing to do? I do think it was the right thing to do. I think for a while it has been reasonably clear that there is deficient demand in the euro area as a whole, and that therefore further monetary stimulus was needed in order to achieve something like an inflation target. And my answer to your question about does the ECB have an inflation target is if their objective is to anchor medium-term expectations around 2%, then yes, that's de facto an inflation target. I don't expect Peter necessarily to rise to that. And I think if you look back a year, when perhaps a year ago the central outlook, the expected outlook was for inflation to remain positive, but even then there must have been a critical mass of the probabilistic outlook that was below zero. And I think the ECB would help both public debate and, I suspect, its own internal deliberations if it cast its public forecasts probabilistically, weighing the upside and the downside. We went through months and months of commentators saying there is no risk of deflation. Every statement of that kind was false when uttered. The only question was, how big was the risk of deflation? We weren't able to debate it that way because it was never articulated that way. The other thing that occurred during that debate, and I experienced this a few times, is you'd say, oh, I hope the ECB would do some QE, and people would say, that's not going to help in Portugal and Spain or Italy. And it took me a few times, so I had practice, I guess, to realize that this was just changing the subject. This is about monetary policy. This is about stimulating nominal demand in the euro area as a whole. And there can be a legitimate debate in positive economics about the amount of slack in the euro area as a whole and the pressures bearing down on costs and therefore the medium-term nominal trends. But that is about the euro area as a whole. It's not about crisis management in the so-called periphery countries. So I think QE is warranted because I think there is deficient demand in the core, and by definition the monetary union, the core can't only be one country, it has to be more than one country, but I think there is deficient demand in the core and further monetary stimulus was needed. How will it work? The best I can do here is to recall some of the thinking that we went through at Bank of England when I was there over Christmas 2008, and Adam, we sat opposite each other.
After that.
Well, you were after that. When did you join?
September 2009.
So QE had begun. Okay, so this is the winter of 2008. My view was get the policy rate down to zero as quickly as possible, while inflation and inflation expectations are still positive, so we can push the real rate, short-term real rate, as negative as possible, as quickly as possible, and start QE as soon as possible. And I have three things to say about QE. The first is, and it is sad that this needs to be said, plainly there can be too much money chasing too few goods. That's how one gets inflation. But there can be too little money out there as well. And if you care at all about broad money, which certainly I do, if you have an implosion in your banking system with a cut-off in shrinkage and credit supply, you can think of quantitative easing and monetary policy more generally as trying to exogenously offset the endogenous destruction of money that the banking crisis caused. This is underlining that this is about monetary things. The second thing to say is we never for 1 second, I don't think any of us thought that it was going to run through the money multiplier, through the banking system. I mean, plainly, as an accounting identity, the banks end up with more reserves. And if your banking system is beaten up, the way to get that working again is recapitalization. And I hope, by the way, as an aside, that transferring supervision to the ECB will bring an end to the forbearance that has prevailed across this continent and start the repair of the banks. So how did we think it would work? We thought that we'd be buying gilts from longer-term savings institutions, taking from them a low-risk asset with nice duration characteristics in terms of their liabilities, and giving them something with nasty duration characteristics, and which was risky, a wholesale deposit with a commercial bank, an uninsured deposit. And we thought that they would first of all charge a premium for selling us gilts, pushing down gilt yields, and therefore the discount rate of all other assets. And secondly, that they would go out and try and buy as close a substitute for gilts as possible, sterling corporate bonds. And that's what happened. More companies issued sterling corporate bonds than in recorded history, which goes back to the 19th century. Many of the companies that could issue used that money, the proceeds, to repay bank loans, which was a form of benign deleveraging. Now, there was also a signalling point as well. Now, why am I telling that story? First of all, it's a monetary story, and I wish Fed, by the way, would talk a bit more about the monetary side of what we've been doing rather than just the credit side. But as a monetary story, this falls absolutely full square in the traditions of the Bundesbank and indeed the two-pillar approach of the ECB. And I think that's an important point. There's no violation or departure from doing monetary policy going on here. The second thing to say is that plainly the current market circumstances are different. Yields are already lower and the markets are better arbitraged. But they're not perfectly arbitraged still, as everybody realizes. And secondly, when people say, particularly in the States and in London, oh, it can't work in the same way as in the UK and America because they don't really have capital markets. You what? The euro-denominated capital market's vast compared to the sterling denominated capital market. Yes, it is a smaller share of the whole, but it exists, and there are long-term savings institutions across this continent, and indeed, as a reserve asset, euros are held around the world. And so people will be selling euros, I hope, to buy foreign reserve assets, which will, a hydraulic effect, will reinforce the signaling effect on the exchange rate, which Peter and others have talked about. Let me say something about politics. One issue has already been touched on, which is, should central banks refrain from providing stimulus so as to put pressure on governments to do structural reform? No, they should not. This would be a violation of the law of rule or of Rechtsstaat principles as prevail in this country. When I was in office, I was powerful, independent, and unelected. Those people do not have a right to depart from the legal mandate that they've been given. But the duty to pursue their mandate gives them another duty as well, which is to explain what they can do and what they can't do. And what they can't do is create higher potential growth, produce higher permanent incomes. And so they have to keep on banging that home. The big issue, though, is this a legitimate monetary instrument at all? And I want to start off, and I'll be quick with this, but perhaps this is the burden of it, with what is the baseline minimal conception of monetary policy? It's that I, the central bank, buy and sell treasury bills so as to exploit their non-substitutability in normal circumstances to push the short-term nominal interest rate about. That plainly doesn't work when you're at the zero lower bound. When you're at the zero lower bound, if that is the limit of one's conception of monetary policy, then the central bank simply has to close and say, we will hold interest rates low as possible for as long as possible, but over to you, fiscal authority. If you don't want your society to close down its central bank then faces two choices, and only two choices. One is to buy government bonds, the other is to buy private bonds. Both carry risks. Both risks can crystallize. If they crystallize, seigniorage will be lower. That is a fiscal event. Fiscal monetary issues become blurred at the zero lower bound. Think of central banking as the following. It is a set of conventions or norms, partly underpinned by law, in which the state delegates to an independent agency a discretion to change the liability structure and, if private assets are allowed, the asset structure of the consolidated balance sheet. That's what an independent central bank does. And if you think about the independent central bank like that, and it is the only way of thinking about it, I believe, then A, you have to accept that fiscal policy and monetary policy are tightly interlinked. And secondly, that there is a major problem if the contract is incomplete. And if the contract is incomplete, you have to do two things. You have to fill it in over time, and secondly, you have to face up to the fact and debate it. So the people of Europe deserved a debate, and they got a debate. Is the debate over? I'm required to stop now, so I won't answer my own question.